So the next part is corporate bonds. So corporations can also borrow money from lenders through issuing corporate bonds. However, there's something to note about bond markets, which is that they often have really thin markets because different bonds are extremely specific, and that's why they come in such a wide variety. Bonds have unique features that only specific investors actually want. For example, a specific investor would only want to hold it for exactly 5 years for a discount, or another investor might want to hold it for much longer. They might want to hold it for 30 years, but they want a generous coupon. And so, because there's such a wide variety of features, that means that different investors prefer different time preferences, risk preferences, and so on, which is why bond markets are very thin. So for this reason, bonds are traded over the counter and can be traded over the counter quite often. So the next part is bond ratings. So bond ratings are like A, B, C, all of those rankings. Of course, A would be the best, and it would just keep going down lower and lower. And this is based on the coupon that the bond pays, the maturity, the price, and the yield to maturity. All of that determines the bond rating. Safer bonds usually means that there would be a lower yield to maturity. So unfortunately, yeah, risk and reward very much align. So now what about call provisions on corporate bonds? Let's go back to corporate bonds and the types. So a call provision on a corporate bond is where a company is allowed to later repurchase the bond. They can call the bond. And a callable bond is just for basically any kind of bond, but this is specifically for call provision on corporate bond. So let's say an example. Why would we want to repurchase our own bond earlier than maturity? Well, if I'm a company and I issued a bond at 10% coupon, so I will get $1,000 in cash from the lender, but I have to pay them $100 per year. Later, if interest rate fell to 5%, then I would have to pay a lower coupon if I issued a new bond. So that's why I want to repurchase and reissue the bond, as in I get refunded or refunding. Let me elaborate on this further. Basically, the rules of coupon rates and bond pricing and interest rates, they're all quite interconnected. The central rule is that if coupon rate equals interest rate, then the bond price is simply the par value or the face value. And if the interest rate falls, then coupon rates will also fall and be able to issue at the same price. And this is basically just describing the fact that, interest is just a safe way to put your money. You can put your money and accrue the same interest as if you invested in a bond. So that's why the market interest and coupon rates, when they're equal, then you can issue it at par value, which is 1,000 usually, or 100 usually. So if the interest rate and the coupon rate, and you'd issue a bond at that exact rate, then yeah, you issue it for 1,000 and interest rate is 10%. Great. So now you're competitive, you're issuing at 10%, and so you get someone to buy your bond. But then later, time passes and interest rate fluctuates. You're already stuck in a commitment to keep your bond and coupon payments the same because coupon rates are fixed, not like interest, which can vary. So if interest rate rises, then you're at an advantage because you are still having to pay a lower coupon compared to what new bonds have to be issued at to be competitive. So as in, if it's 10% interest, but then it rises to 15% interest, you only have to pay 10% coupon rate, but others have to pay 15% coupon rate to be equal to market interest rate for new bonds and to be able to issue at par value. Otherwise, if they tried to issue at 10% coupon rate like you are right now, even though the market interest rate suddenly rose to 15%, then why would investors choose to buy that bond when they could instead invest in other things that would pay them the 10% interest, right? So that's really the core. Market interest rate is basically a sort of benchmark for what newer bonds can issue. So yeah, let's see. So yeah, calling would be great if the market interest rate fell. If it decreased, that's great for you because now you can repurchase your bond and then have to pay lower coupon payments for the same $1,000 par value that you would issue as a bond, right? So very easy intuition when you get it. Just think really that the interest rate or the market interest rate sets the benchmark, and anything above or below it is discounted or premium. So yeah, it really has to be then right at the interest rate. So let's go back to the callable bonds. So if a bond has a call protection period, this is called deferred callable bonds. And a call protection period is basically a period in time where the borrower cannot just say that they want to repurchase their bond and then issue a new one, right? So the fact that it's deferred kind of protects the lender for a while because they can't just the borrower can't immediately just get rid of the bond that was for a higher coupon. However, overall, callable bonds are lower in price just because there's a greater risk to the lender because the borrower has the right to repurchase their bond in the case that interest rates fall. And so, not only do callable bonds have a lower price, they may also have higher coupons and a higher yield to maturity in order to compensate the lenders. So, what about convertible bonds? So, the convertible bonds will give bondholders the option to exchange the bond as a number of the company's shares. This is especially beneficial if a company's price of, because these are corporate bonds, if the company's share price rose and you wanted to purchase shares or convert it to the shares. So the conversion ratio is how many shares from the bond exchange. So it's basically the share to bond ratio. And then the market conversion value is the value as dollars that the bond can be converted, or as any currency. And then the conversion premium is the excess value of the bond over its conversion value. So basically the gains. So let's look at an example, right? there's a $1,000 bond that you can convert to 40 shares that are valued at $800, as in there's $20 per stock. That's the stock price. So 20 times 40 is $800 value currently. So the conversion rate here is 40 shares for the $1,000 bond, right? The market value is, what are the shares valued at? As we said, it's $800. And the conversion premium, you don't get any premium, right? There's no premium to converting it because there's no profit that you would gain. And the shares haven't risen in price yet. So then the stock price rises to $30. So the new value of the shares is going to be 40 times $30 is $1,200. So this is profitable. So you could sell it for 1,200 minus 1,000, as in the bond price, equals $200 in profit. So the market value is still $800, but then it rose to 1,200, which is why there's a conversion premium of 1,200 minus 800 equals $400 premium from the start. So yeah, the conversion premium is basically like the value of the shares initially and then the value of the shares later and the profit that you could gain. So now, what about a puttable bond? Instead of the issuer being able to call the bond, it's actually the lender or the bondholder that can extend the bond or retire the bond. So they have the choice instead. Let's look at an example. Say I have a bond. I'm getting paid 10 euros for my 1,000 euros investment. But if the coupon rates of my bond are higher than the market's coupon rate, then I won't retire my bond. However, if the interest rates rose in the market, like the market interest rate rose to like 5% instead of 1%, then I would rather get those new bonds and be paid $50 for my 50 euros for my 50 euro investment. So I would then retire my bond and then get a new one. So the next type of bond is floating rate bonds, which is bonds that make interest payments tied to some measure of current market rates. So the rate is adjusted annually, for example, to a Treasury bill plus 2%. For example, if the Treasury bill is 4%, then we make the coupon rate 6%, which is 4 plus 2, 6% for that year. And then for the next year, if the T-bill is then 3%, then we'll do 3 plus 2, so we make our coupon rate 5%. So basically, it just adjusts the coupon rate every single year based on a specific measure of market rates currently. So the bond thus always pays approximately the market rate. There's a major risk in floaters. Just because the coupon rates change along with the market rates or like a measure of current market rates, that doesn't mean we're fully protected. Because a firm's financial strength can change. Even though we're protected against, market rate fluctuations, we are not protected against the firm's financial health being worse or riskier. So even if we wanted to demand more compensation, we're still being paid a fixed rate.